So with regard to that particular question, I want you to, in this case, confirm to me whether you have this figure. I want you to confirm to me whether you have this figure. I want you to confirm to me whether you have this figure so that I can be able to know we are together. I want you to confirm to me whether you have this particular figure here. So of course, in this case, we were reporting our figures in shillings of thousands. We were reporting our figures in shillings of thousands. So you can confirm to me whether in this case you have this figure, net cash flows from investing activities. So net from investing activities, net cash flows from investing activities. It is supposed to be a figure of 20,595. So confirm whether you have this figure. And of course, yet closed. I can see Jim Bosco has confirmed. What about the others? You need to confirm a number of you so that I can be able to know. I can be able to know whether we are together. Yes, I can see Evans, yes. I can see Innocent, yes. Innocent, yes. I can see you are saying yes, yes there. So I think in this case, we left at the point whereby in this case, we were just finalizing on having to look at cash flows. Cash flows from financing activities. Cash flows from financing activities. So cash flows from, in this case, what? Financing activities. And in this case, we said in this case, majorly here you look at, in this case, the equity items, and of course, in this case, maybe the non-current liabilities. Maybe there was a loan that in this case was actually acquired. So with regard to this, we said there's an item of what? Issue of shares. Issue of shares. So for issue of shares, you need to in this case look at the ordinary share capital. What was happening to it? Look at the ordinary share capital in the trio balance. What was happening to it? The ordinary share capital in the trio balance. What was happening to it? So in this case, under issue of shares, you look at the ordinary share capital, and of course, there's when you're having to issue shares, in this case, you normally have what? The share premium. The share premium. So of course, you can see at the start of the year, this amount for ordinary share capital, it is 40. And at the end of the year, it is actually 50. The amount for share premium, you can see at the start of the year, it is actually 10. At the end of the year, it is actually how much? 12.5. It is 12.5. This share premium arises when you issue what? Shares. When you issue shares. So for us to know in this case, whether we had any form of inflow during the year with regard to issue of shares, it will be quite obvious. If we had an ordinary share capital of 40 at the start of the year, then at the end we have 50. It means there were some shares which were issued, leading to, in this case, what? The capital to increase up to 50. And in this case, if the share premium increased, it means that in this case, these shares probably were actually issued with what? With a premium. Therefore, having to bring in what we call what? Cash. Therefore, having to bring in what we call what? Cash. So at the start of the year in totality, with regard to these ones, we had 50, but at the end of the year, we had 62.5. 62.5. So bringing in a net of 12.5, bringing in a net of 12.5. So this one you can be able to have 62,500 minus 50. 62,500 minus 50. So in this case, you'll have 12,500, which will be a positive because it was an increase. It means more money came in as a result of what? Sale of shares or issue of shares as a result of sale of shares or issue of shares as a result of sale of shares or issue of shares. Then there's another item. If you look at, in this case, our format, we said in this case, under the financing activities also, you can always, in this case, be able to confirm whether there was actually, in this case, any form of dividend which was actually paid. Whether there was actually any form of dividend which was actually, in this case, done what? Paid. So in this case, to know how much was actually paid as a dividend, we need, in this case, to look at this particular account here, we call what? The retained earnings. Retained earnings account. Retained earnings account. So retained earnings is an income to the business. It's actually an income to the business. Retained earnings is an income to the business. Is an income to the business. So you can be able to prepare this account. So in this case, we had a balance brought down in terms of retained earnings of how much? A balance brought down of retained earnings of how much? Look at the figures you have in the question. Look at the figures you have in the question. Try to juggle your mind. Try to juggle your mind. Look at the figures that you have in the question. Look at the figures you have in the question. So it was an amount of 14,755. It was an amount of 14,755. It was an amount of, in this case, 14,755. It was an amount of, in this case, 14,755. An amount of 14,755. 14,755. 14,755. Then at the end of the year, so in this case, at the end of the year, in this case, if you look at the, is in that, in this case, that, is in this case that, so we have in this case, profit before tax. We have in this case, profit for the year. So there was in this case, a profit which was actually in this case realized for the year, of in this case, 33, 35, or 33, 35, 33, 35, 33, 35. Then, if we look at in this case the TIO balance, if you look at the statement of financial position that you have there for Beta Limited. So when you started the year, in this case, we had 14,755 as per the retained earnings you're having to be told there. Then at the end of the period, there's a balance carried down of, in this case, 17,505. 17,505. There's a balance carried down of 17,505. These are at the end of the year. At the end of the year, 2024. But now during the year, they earned somewhat retained earnings. They earned some profits for the year. They earned some profits for the year. These profits that were realized are in the profit statement extract of 33.35. So profit for the year that in this case was actually realized, it is 33.35. 33.35. So 33.35, 33.35 was actually realized during what? During the year. So in this case, in the P&L account, in this case, you have what? 33.35. 33.35. 33.35. So if you add in this case, there's one of the sides that in this case you likely end up having to realize that in this case is actually more. For example, in this case, if you add, you need to be able to add and actually see. You need to be able to add and in this case see how much is the total there. How much is the total? So when you add this one, so 14,755 plus 33.35, what do you get? I think you'll be able to get something like 18 something. 18, you get 18, 18,090, 18,110, which is which? 18,090, 18,110, which is which? It's supposed to be 14,755 plus 33.35. 14,755 plus 33.35. So that is the profit from what? Profit for the year from the extracts. Is it 18,090 or 18,110? So 18,090 or 18,110. So this one is 0. This one is 9. This one is 0. This one is 8. It is 18,090. 18,090. 18,090. So it means what you'll be able to have here as a difference is what in this case was actually paid as a dividend during the year. So it's what in this case was actually paid as a dividend during the year. What it means in this case, ideally, if they opened with the retained earnings of 14,755, then they gained this one. This was the profit from the operational activities of the business. From the overall operations of the business, they were able to get a profit during this year of 33.35. So it means by the end of the year, they are supposed to be having this, but ideally they had less. Why was it less? There must have, in this case, have actually been a dividend that they ended up having to pay. There must have actually, in this case, been a dividend that they actually ended up having to do what? To pay. So therefore, in this case, we'll have cash, which was actually paid in form of dividends, which is the balancing figure. What is the difference? You'll be able to get a difference there. You'll be able to get a difference there. What is the difference? It is 585. So they must have paid a dividend because ideally, if they had this at the start of the year, then they gained this one during the year. In totality, by the end of the year, the retained earnings are supposed to be this, but they had less. So they must have paid in this case what dividends there of 585. So we'll have in this case dividend paid as per that working of 585. If it was having to be paid, that is what an outflow. Is actually in this case what an outflow. Then the other thing you can be able to look at is you can be able to look at the equity items. We've looked at in this case ordinary share capital, the share premium. The revaluation reserves in this case do not actually in this case reflect real inflow or outflow of cash. So don't actually deal with that. So you can be able to leave it there. Then the retained profit has actually been able to enable us to identify whether there was a dividend that was actually paid. Then we have in this case what the long-term borrowings. So long-term borrowings. So we have in this case long-term borrowings. These long-term borrowings, if you look at the balance, the opening balance is actually 10,300, but by the end of the year, it is 11,600. There must, in this case, have actually been an inflow of more borrowings having been done. So in this case, it will be 11,600 minus 10,300. 11,600 minus 10,300. What you get? You get 1,300. You get 1,300. I think it is 1,300. It is an inflow, and therefore you add. You don't actually deduct. It's an inflow, and therefore in this case you end up having to add. You end up having to add. So these are part of what in this case you can actually be able to put under what the financing activities as per the question there, and therefore you can be able to get the total. You can be able to get the total of these three. I want you to get the total of these three. 12,500 minus 585 plus 1,300. 12,500 minus 585 plus 1,300. You get 13,215. So 13,215. 13,215. So these are now the total cash flows from, in this case, what? The financing activities. The total cash flows from the financing activities. So overall, in this case, you can now, in this case, get the figure for the net cash flows. Net cash flows, net increase or decrease in what? The cash flows. So you can, in this case, get the net increase or decrease in the cash flow, the net increase or decrease in the cash flows, the cash and cash equivalents, net increase or decrease in the cash and cash equivalents, net increase or decrease in the cash and cash equivalents. So you can be able to maybe mark them. So this one can be C, this one can be B. Then the total amount in this case under operating activities, the total amount you got under operating activities indicate as 1. It is up there. It is up there. It is up there in your book. You indicate number A. So it will be A, B, C. So in this case, what you'll do, you'll simply add the 3. A plus B plus C. It should be able to give us, in this case, what? The net increase or decrease in the cash and cash equivalents. So what do you get as the net increase or decrease in the cash and cash equivalents? You need now to add the 3 figures. So we got 3 key figures. One, it was the total for, in this case, what? The cash flows from operating activities. Another one, the total in this case for what? The net cash flows from what? Investing activities. Another one, it is from, in this case, what? The financing activities. So you get 255. So 255, another person should be able to confirm that figure. At least you should be able to have another person having to confirm whether it is correct. From Mercy. That figure from Mercy. We can't, in this case, just be quite certain. At least 2 or 3 people should be able to confirm. I can see most of you having to say 255. 255. So what happens here? You now, in this case, add on this one. You likely end up having to add on this one the opening cash and cash equivalents. The opening cash and cash equivalent. What is the opening cash and cash equivalent? Who can identify for us the opening cash and cash equivalent? Who can identify for us the cash and cash equivalent? Who can identify for us the cash and cash equivalent? It is an amount of how much? It is an amount of 2230 or 2330. 2330 or 2230. It is actually in the statement of financial position. You go and actually, in this case, look at the current assets. Look at the current assets. look at the current assets, it should be able to give you in this case what the cash and cash equivalents, which in this case it means that is the final figures of in this case the cash at hand, the cash. Remember in this case when you talk about the cash flow, it's all about in this case having to look at how cash was moving out and how cash was coming in. So it will give you the net effect by giving you what the balances at the end of the period. So the opening balance in this case is actually 2230. 2230 is 2230. 2230. When you add what you get, when you add there's a figure you'll be able to get. When you add there's a figure you'll be able to get. So it is supposed to be in this case 5842. So 2485. 2485. This one should be the closing cash and cash equivalents. So this is what will be able to tell you that in this case, your cash flow is actually balancing. So when you in this case add the figure you get, should be able to get here. When you add the opening, you should be able to get the final end figure. The final end figure, I know you cannot be able to see there, but you just write closing cash and cash equivalents. Closing cash and cash equivalents is equals to 2485. Closing cash and cash equivalents is equals to 2485. You can write there. Closing cash and cash equivalents is equals to 2485. 2485. That is the end of, in this case, that particular statement there. So take note of key in this case, what accounts that you can be able to prepare. So the retained earnings is very important because it will help you to get what the cash dividend that was actually in this case what paid. There's also in this case what the income tax account. Income tax account, very important. We prepared it. I hope you took note of it. It will help in this case to, in this case, determine the tax paid. The tax paid. Another very important account that never misses in this case, the property, plant and equipment account. It will help in this case to know whether in this case there were any assets which were acquired. And of course, we prepared these accounts. It was not just for the sake. Hope you drew them. It was not just for the sake. So this one here, retained earnings, it will never in this case, for example, miss to help you to get what the cash dividend that was paid, which eventually comes here as part of what the financing activities that occurred there. We'll have in this case what the income tax account, which will have like two elements. There, the current tax and of course the deferred tax. You have to in this case look at what was changing, what was the opening balance. Maybe we just done the ending balance, what was, for example, in this case paid for the year. It will be able to give you a figure that in this case will be able to tell you how much was in this case paid as a tax during the year. The property, plant and equipment accounts, it will give you the opening balance of the properties. And in most of the instances, in the additional information, you will see they have told you some assets were acquired, others were disposed. At a particular point in time, they're having to be disposed. This was actually the depreciation. So you need to look at the net effect, and of course, it will be able to tell you the additional assets which were acquired. That simply means in this case, money was spent to acquire what? The assets. To acquire the assets. So of course, you'll be able to look at another question for cash flow statements. But now, I want us to look at something else. Just still from published financial statements, I want us to look at another question. Just still from published financial statements, I want us to look at another question. So just from the same setting, you need to look at this particular question here. There's this other question here. It is question number 4. So December 2024. December 2024, question number 4. December 2024, question number 4. December 2024, question number 4. So confirm whether you are there. Confirm whether you are there so that we can be able to start. Confirm whether you are there so that we can be able to start. December 2024, question number 4. I can see Michelle says yes. I can see people are saying yes. Yes, you can see everyone says yes. So we'll go through it. It says Farm Unlimited has been in the operation for the past 15 years, dealing in the agricultural produce processing business. The following trio balance was extracted from the books of the company as of 31st of October 2024. You'll be given some items there. Revenue, income from investment, so all those ones. So those ones on the credit side, probably in this case, they are income items, or in this case, what? Then in this case, what equity items? For example, you have retained earnings, 8%, loan stock, accounts payable, deferred tax, bank balance. Land and buildings at cost, plant at cost, they are accumulated depreciations. We have purchases, we have distribution cost, admin expenses, loan interest that was actually paid during the year. We have leased plant rentals, rental payments that was done during the year. Dividends paid of 15,000, 15 million ideally. Inventory, the opening inventory for the year under which you are having to account for. The accounts receivable, then of course you have what investments, which in this case are long-term investments. We have in this case long-term what investments. That is in this case what an asset. So as at 31st of October, the closing inventory was actually valued at 43,200,000. The land and buildings were purchased on 1st of November 2008. The cost of the land at the date of purchase was actually 70 million. However, on 1st of November 2023, the land and buildings were professionally valued at 175 million and 80 million respectively. The estimated useful life of the buildings before revaluation was actually 50 years. However, the revaluation did not change the useful life of the buildings. Plant is depreciated at 15% per annum using the reducing balance method. So the plant items will be able to depreciate them at 15% per annum using the reducing balance method. Then depreciation expenses are to be included under the cost of sales in the income statements. So it means when you calculate the depreciation for the PPE, property, plant, and equipment items, we likely end up having to include them as part of what the cost of sales expense. Then you are told on 1st of November 2023, Farmland Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years, the annual rent of which was payable in advance with the effect from 1st of November 2023 was actually in this case 22 million. The fair value of the plant is 92 million and the implicit interest rate on this item is actually in this case what? 10%. So that is what we call what leases. So it means you have to like apply some knowledge there of leases, what we learned in leases, very important. Then the 8% loan stock was issued on 1st of January 2024 and interest is payable 6 months in arrears. Payable 6 months in arrears. It is payable 6 months in arrears. The income tax for the year ended 31st of October 2024 is estimated at 28.3 million. The deferred tax provision as at 31st of October 2024 was to be increased to shillings 14.1 million. You are required in this case to prepare the following published financial statements. Statement of profit or loss for the year ended 31st of October 2024. The statement of changes in equity. Then you have the statement of what? Financial position. Statement of financial position. Statement of financial position. So of course now in this case, as I told you, it just depends in this case with how you want in this case to approach these particular questions here to just maybe in this case to be able to save on time. So some of in this case the entries you'll be able to make in the final statements. Some of the entries you might end up having to make in the final statements. Some of them might not actually have in this case what adjustments. Might not actually end up having to have what adjustments. So probably in this case, if you want to save on time and in the exam, because in this case, once you've been able to go through so many of them here in class, you know, like in this case, the most obvious ones that normally have adjustments, they're like these ones and these ones. The others, like in this case, they don't have any form of adjustment. So you have an option. You can, in this case, maybe prepare what you call what a skeleton of what? Of the presentation. A skeleton of the presentation. For example, in this case, quite obviously, you know that in this case, when we prepare a statement of profit or loss, we'll start with what? The revenue. The sales revenue, then we'll go to the cost of sales. Under cost of sales, in most of the instances, you less the cost of sales. In most of the instances, it'll have adjustments as we've already been able to see in class. Probably there'll be an item of depreciation. You have to add on that cost of sales, or you might be told something else. But in most of the instances, you'll be told what? Depreciation. So what I mean by this, you can just be able to prepare what a skeleton. Sales revenue rarely to have adjustments. Very rarely to have adjustments. You can just find in this case, that is just an easy entry you can be able to put without having to, in this case, do what? Adjust. So those items you feel like in this case, they won't have any form of adjustment. And in most of the instances, for example, if you have actually gone through the additional information, you can tell like which ones. Like in this case, in most of the instances, you've actually been seeing that the depreciations will actually go to maybe in this case, what cost of sales, admin expenses, or they'll actually end up having to go to in this case, what distribution expenses. But here, ideally, the items of depreciation we've actually been told all of them will actually go to cost of sales. So it means in this case, our figure in the profit or loss statement, it won't have any adjustment. The admin expenses and of course distribution won't have any form of what adjustment. So it just depends in this case how you want to, in this case, to approach it to save on time. Because I can tell you sometimes if you start with the workings, it might end up having to take a lot of time. Yet, if you just in this case prepared a skeleton, whereby you leave those entries that in this case you feel like have adjustments, you'll be able to deal with them as you complete the workings later on. It will be far much better. You might realize in this case that without even having to touch on a working, you might easily score even 8 out of 20 or even 10 out of 20. Because in this case, ideally, there are those figures you've already realized. When we do the questions, they like in this case, don't have adjustments. Like trade payables. Rarely it has what adjustments. The deferred tax at the end of the period, the one that you place in the statement of financial position, you just go to the sheer balance and you pick it the way it is. You don't adjust it. The one that you'll end up having to adjust is the one that in this case you place in what? In the P&L account. The trade payables, it doesn't have. Rarely it has what adjustments. The current tax figure, in most of the instances, you'll be given the additional information. And rarely in this case, it will have any form of what in this case adjustments. The one that in this case you'll end up having to adjust, it is the income tax expense that you place in the P&L account. So if you are quite smart enough, you can in this case just score your cool 8, even 8 or 10 out of 20 marks without having to touch on what? On a working. It just depends with what? The average. Because I can tell you sometimes if you start with the workings, sometimes it takes what? A lot of time. So by the time you comprehend them, they'll end up having to mix you up. By the time you're trying now to start to draw them, you're having to be told 1 hour to go. Yet in this case, you've done only how many questions? 2. Is because in this case, you never took what? The far much better approach of having to do what? Answer the question, having to answer the question. So in this case, I just in this case be able to take you very fast through those particular workings that are actually there, so that in this case you can be able to understand how you can be able to approach them. Then eventually in this case, when we be doing the final accounts, I'll be able to tell you in this case which ones we haven't actually been able to touch on, that you can just in this case easily place the figures without having to do any form of calculation. So in this case, let's look at in this case part of the key. For example, the closing inventory, you can see it doesn't have adjustments. So it means when you prepare a skeleton of the statement of financial position, you just go to additional information number 1, pick the figure the way it is. You place it there, you get a mark. You get a mark without having to touch any form of what? Any form of working. So if you look at in this case additional information number 1, so that one doesn't have any form of issue. So it means in this case it will be our what? Our closing stock. It will help us to get what? The cost of sales. It also end up having to help us to get the figure to place in the statement of financial position as what? As the closing inventory with 0 adjustment. With 0 what? Adjustment. Is a mark you can just be able to score without touching any working. The reason I was having to tell you that in this case, you can't in this case walk into a financial reporting exam and in this case say you'll get out of it under the workings of basically presentations you score 0. You cannot score 0. You cannot score 0. If you score 0, it is just your own problem. It's just your own problem. Because I can tell you there are figures that don't have any form of working or adjustment. In fact, in this case, you are very keen, as I'm having to tell you, you can easily score 8 out of 20, even 10 out of 20. Surprisingly, even in this case, 12 out of 20 without having to do what? Touch a single working. So it depends with what? The strategy and of course what? The approach. Because I can tell you sometimes if you start with the workings, there's a working that in this case will end up having to mix your mind. By the time you're completing it, 15 minutes have gone. 15 minutes have gone. And of course, that is normally the challenge with the students having to do financial reporting. By the time they're having to say, the supervisor is having to say 1 hour to go, they have only done 2 questions. They're only done what? 2 questions. But in this case, we are very smart enough. In this case, you can just end up having to maximize and look at the very strategic areas where you can be able to maximize your marks, and you just easily score the marks. So the approach is very important. The approach, the strategy as far in this case, you'll be able to tackle the paper is very important. That is in this case what will end up having to make you to do what? To pass. It will make you to pass. So we can look at in this case, these additional informations. So I just in this case help you how you can be able to approach some of the workings there, because I know they are the ones that in this case will end up having to confuse you. So additional information number one doesn't have an issue. The one that has a problem is number two. You have to be very keen about this one, because this is the one that will take you 15 minutes if you're not actually very careful. You're having to be told land and buildings were purchased on 1st of November 2008. So these ones were purchased. So land and buildings. These ones were purchased on 1st of November 2008. So at this particular point in time, before the start of the year, 1st of November 2023, this means this was actually how many years back? It was actually 15 years back. It is actually 15 years what back? It is 15 years have already elapsed since these items were actually in this case done what? Purchased. And at that particular point in time, they are having to be purchased. You can see in this case, we have what? The cost. We have in this case the cost of these items. We have the cost. So of course, in this case, you have land. And of course, in this case, you have what? Buildings. We have land, and of course, you have buildings. So for land, the cost of land at the date of purchase was 70 million. So this one was actually 70 million. So you can, in this case, our workings are actually in thousands. We can say our workings are actually in thousands. If in this case, this was 70,000, it means the cost of buildings, when they are having to purchase them in 15 years back, this one for buildings was actually 200,000. Therefore, in this case, it was 200,000. Therefore, in this case, giving us now the total we're having to see in the TIO balance of, in this case, how much? 270,000. Giving us a total of, in this case, how much? 270,000. But now, this is what you're having to be told. The cost of land at the date of purchase was 70, which means this one was 200. Then, however, on 1st of November, after 15 years, the land and buildings were professionally valued at 175 million and 80 million respectively. There's a correction you have to be able to do there. There was a correction you have to be able to do there. So the cost of land at the date of purchase was 70. However, on 1st of November, the land and buildings were professionally valued at, you can be able to interchange those. You see the way they have written the land and buildings. You can say the buildings and the land. The buildings and the land, you say the buildings and the land, you interchange, you correct that particular additional information, you say the buildings and the land, not the land and buildings, say the buildings and the land were professionally valued at 175 million and 80 million respectively. So it just depends. Maybe alternatively, you can change the figures, or you can in this case alternate the wordings there. You say the buildings and the land were professionally valued at 175 million. So in this case, it means after 15 years. So in this case, on 1st of November 2023, the start of this accounting year, we're having to account for. These ones now were having to be valued at how much? 175 million. And these ones were having to be valued at, in this case, how much? 80 million. Yes, 80 million. These ones are having to be valued at what? 80 million. They were having to be valued at 80 million. But you have to take note that these buildings, they were depreciating. So land doesn't depreciate. Lands always does what? Appreciate. But these ones are having to depreciate. And of course, you can be able to see the accumulated depreciation, the accumulated dip was how much as per the TIO balance? The accumulated dip was how much as per the TIO balance? It was how much as per the TIO balance? It was how much as per the TIO balance? Accumulated depreciation on buildings, it was how much as per the TIO balance? Look at the TIO balance. Look at the TIO balance. I want you to give me that particular figure. It was in this case how much? 60. It was in this case 60,000. So 60,000. So it means it had already lost a value of, in this case, how much? 60,000. So it means at this particular point in time, this asset here, the net book value is how much? At this time, you're having to revalue it here. The net book value is how much? The net book value is how much? The net book value is how much? Frida, try to juggle your mind. The net book value is how much? Currently, when you're having to revalue it, the net book value is how much? It is 140,000. So the NBV is actually, in this case, 140,000, because it had already lost how much? 60. By the time we are revaluing here, this asset has already lost how much? 60. It has already, in this case, lost how much? 60. It has already lost how much? 60. It has already lost how much? 60. And therefore, in this case, the NBV at this particular point in time you're having to revalue is actually, in this case, 140,000. So therefore, in this case, the revaluation that actually arose, the revaluation that in this case actually arose, it means in this case, for this item of land, it was an amount of 10 million. For this item of, in this case, buildings, it was how much? You can see this one increased to 80, so it is 10. The revaluation that arose there was 10. What about for buildings? What about for buildings? It was how much? It was 35. It was 35 because at this particular point in time, you're having to revalue it. The value is 140, but it was revalued up to 175. So it basically brought about a revaluation of, in this case, 35,000. So in total here, it means we had a revaluation of how much? 45,000. 45,000. This particular amount here, it will go to the revaluation reserves in the statement of financial position. This will go to what? The revaluation reserves in the statement of what? Financial position. Statement of financial position. Statement of what? Financial position. But now there's something in this case you're having to be told. We just need to continue to read the statement. You're having to be told that the estimated useful life of the buildings before revaluation, when they acquired them here 15 years ago, the useful life here, the useful life indeed was actually how much? 50 years. It was actually 50 years. It was in this case, what? 50 years. When they acquired them, it was 50 years. But now remember, already 15 years have already elapsed by the time you're having to revalue them. So you are told the estimated useful life of the buildings before revaluation was 50 years. However, the revaluation did not change the useful life of the buildings. It didn't change what? The useful life of what? Of the buildings. It didn't actually change the useful life of the buildings. So therefore, in this case, we have to determine in this case what? Depreciation on buildings. Which in this case, it means when you're normally given the useful life, you normally take the value of the asset, divide by, in this case, what? The useful life. You divide by the useful life. So in this case, at this particular point in time, the value of this asset is actually what? 175. At this particular point in time, start of, in this case, November, the value is actually how much? 175. Because it was revalued, the value in this case is actually what? 175. And of course, in this case, if you are given the useful life, you normally divide by the useful life to get the depreciation per year. The depreciation part per year. So in this case, we'll say 175,000 divided by what? 175,000 divided by what? Divide by, hey, I can see 35 years, I can see 50 years, I can see 50 years, I can see 35. 35 is correct. 35 years is correct because already 15 years had already elapsed. So 35 years is correct because already 15 years out of the 50 years had already elapsed. Then they revalue to what? 175. So in this case, the remaining useful life now, in this case, after evaluation, it is 35. This asset will only exist for the next 35 years because already 15 years have already done what? Elapsed. So we have a new value, and of course, in this case, what? A new useful life from this particular point in time that is remaining exactly what? 35. And therefore, in this case, depreciation for this asset for this year is equals to how much? Is equals to how much? Is equals to how much? Is equals to 5,000. Is equals to 5,000. 5,000. Automatically, this one will likely go to what? To the P&L account for this particular year. We have to take note to whether you'll likely be told whether it will likely go to the cost of sales, admin expenses, or distribution, because that has been the norm with regard to what? Published financial statements. There'll be somewhere you'll likely be told where the depreciation for the item will likely go. So in this case, if you just continue reading, you'll likely be told in this case, it will likely go to what? To the cost of sales. So the final statement there tells you to be able to go to the cost of sales. So we'll take this one to the cost of sales. When you're calculating cost of sales, you'll have to add on this amount that you've just been able to determine here. Just the same statement is having to tell you, plant is depreciated at 15% per annum using what? Reducing balance. So in this case, you have what? Depreciation on plant. Depreciation on plant. In this case, you are told this one is 15% on the reducing balance. So it means you'll be able to take 15% we multiply in brackets. When they talk about reducing, you have to check what was the cost of this plant. What was the cost of these plant items? It was in this case 156,000 minus the accumulated dip. By this particular point in time, you are depreciating because it's reducing. You have to reduce the accumulate. It is reducing balance method. So in this case, you reduce that amount, and of course you multiply. What you get in this case as the dip for plant, as the dip for plant. What are you getting as the dip for plant? You're getting in this case 19,500. So in this case, you'll be able to get 19,500. So you just continue to read. You are told that depreciation expenses are to be included under cost of sales in the income statement. So all these ones will go to the cost of sales. The depreciation expenses will actually go to the cost of sales. So you have to indicate that, because when we calculate the cost of sales, we'll consider this particular two figures. Then this one will be able to consider it when you go towards the statement of financial position, or what? The statement of changes in equity. Statement of changes in equity. So you have to take note where those figures will actually be going to. So we would have in this case been able to complete this one in this case for what? For depreciation. So working one for those items regarding what? Depreciation of those items, would have actually already been able to deal with it. So I want to wrap, because in this case I want us to look at note number 2. I want to wrap. I can see everyone says my mic is not okay. I can see everyone says my mic is not okay. It is low. It is very low. You're not able to hear when I speak. You're not able to hear when I speak. You're not able to hear at all. Okay, hope it will be better. It will be better, but I think by the next class, maybe tomorrow, I would have really improved on it. I would have really improved on it. So I would have really improved on it. So have you been able to complete? Because I want to wrap, we go to the next note very fast. We need to try and actually save on time. You tell me that in this case, I can be able to wrap. So we can go in this case to the next note there. The next note there regarding what? The item of plant. There was in this case done what? There was in this case list. There was in this case list. So in this case, you are told that the list, or basically this is the fair value of the list liability, how you end up having to get the right of use of the asset, and of course in this case how you deal with the leases with regard to what? Leases in advance, and of course lease payments in what? In arrears. Like in this case, these particular lease payments are having to be paid in what? In advance. They're having to be paid in what? In advance. They're having to be paid in advance. They're having to be paid in what? In advance. So hope it is okay now. I can see you are complaining the board is not there. Hope you can be able to see now. So the board is now there. The board is now there. Yes. So these leases were having to be paid in what? In advance. So we can in this case look at working two with regard to what? Leased plant. A leased plant. So for the leased plant, already you've actually been given what? The fair value. So just be able to do a calculation here. Of course, in this case, you are so much very familiar with it. As far in this case, we are calculating for the lease liability. In this case, the payments are having to be done in what? In advance. So in this case, if it happens the lease payments are having to be done in advance. The lease payments, advance lease payments. We have advance lease payments. For advanced lease payments, we had said that in this case, you can actually be able to calculate what the lease liability, of course, so long as you've been given the rental payments, and of course, you've been given what the implicit interest rate. You've been given the implicit interest rate. So in this case, the lease liability here, let me just do this particular card. The lease liability here will actually be equal to what? The rental payments. The rental payments, you multiply by the present value interest factor of annuity. Present value interest factor of annuity. But in this case, having to consider what? The number of years. The number of years. And in this case, the lease payments you're having to be told that are having to be done, which are having to be done in advance. Remember, if you are doing in advance, there's a way in this case you calculate. This particular lease was actually for how many years? 5 years. And therefore, in this case, you'll be able to take the rental payment, which in this case is actually 22 million. You multiply by, in this case, what? 1 minus 1 plus the implicit interest rate is actually 0.1. You raise to, in this case, what? -4. -4 over, in this case, what? 0.1. 0.1. 0.1. 0.1. 0.1. So remember this one, you know it from financial management. So 1 minus 1 plus r raised to -n over r. So it's the present value interest factor of an annuity, where in this case we have what? Equal annual payments. Annuity simply means what? Equal annual payments. When you do this calculation, what do you get? Just give me the figure you're having to get. Just give me the figure you get 60 something. You'll get 60 something. There's a figure you'll be able to get. You'll get 60 something, a figure of 60 something. You'll get a figure of 60 something. What is that figure? So just do the calculation there. You'll get 69,737. So 69,737. This is the figure you'll likely end up having to get. And take note in this case that here we put -4. The years were 5, but we put what? 4. So if they're actually in advance, you only consider those payments which have yet to be paid. Remember, if it's having to be paid in advance, it means one of the payments has already been done. By the time they are starting, you start by having to pay this 22. So you can't discount already what you have. You can't discount what you already have. You normally discount those ones having to be paid in what? In future. There are still 4 payments remaining. 4 payments remaining. So 4 payments are having to remain. So in this case, you use what? 4, not 5. Because it is actually what? In advance. Remember, if it was in arrears, we say you normally consider what? The entire period, 5 years. But if it's actually in advance, because there's already an initial payment done, you don't discount it further. You don't get the present value further because it is already in the present. So what is the essence of having to do it? You don't actually do it, but you use, in this case, what? 4. So you'll be able to get this particular figure here, 69,739. So this is, in this case, what? The lease liability. It is the lease liability. It is the lease liability. Then we said once you have this figure, you can actually be able to get what? The right of use of the asset. And how do you get the right of use of the asset? You take this lease liability here, the fair value of the lease liability that you've just been able to get. The fair value of the lease liability here, 69,737. In this case, you end up having to add on any advance payment or initial payment that was actually done. And that will be quite obvious in advanced leases because already initially they had paid how much? 22. They paid, in this case, what? 22,000. When you add, what do you get? You get 91,737. 91,737. So that is the right of use of what? Of the asset. The right of use of what? Of the asset. You'll get 91,737. 91,737. So you have to, in this case, remember under leases, there are key things you have to calculate. You have to calculate the fair value of the lease liability by having to, in this case, do what? Discount the rental payments. You have to discount, in this case, what? The rental payments. You have to discount the rental payments. You have to discount the rental payments. You'll get 91,737. This 91,737 is now that figure you have been given there, 92 million. They just rounded off. They rounded off in this case to what? To 92 million. To 92 million. So that's what in this case the exact. Sometimes he can give you this figure, or you can actually end up having to leave it. You calculate by yourself. But what I've realized in the most recent settings, they normally give you the fair value of the lease. So what it means in this case, what I did in this case, it actually means it means that this is actually the fair value of the asset. The fair value of the asset, 92. This is the fair value of the asset. The right of use of the asset, the fair value of the asset, the right of use of the asset is actually in this case what? 92. Were you not given this amount here? This is how you could have been able to calculate it. This is how you could have actually been able to do what? To calculate it. But the examiner rounded off to the nearest 92 and he gave you the figure. He gave you what? The figure. He gave you the figure. He gave you the figure. So therefore, in this case, if you have this right of use of the asset, right of use of the asset, you can in this case calculate what we call what in this case depreciation. Depreciation on the leased asset. We can now be able to calculate what depreciation on the leased asset, because what you normally take in this case is this right of use of the asset. This right of use of the asset, because you've been given the value, just take the one that you've actually been given, 92. Don't use this one because you've actually been given. I was just showing you how you can arrive at it, because you never know this examiner. He can hide for you this figure. He can hide for you this figure, but this is how you end up having to get it. So you'll take this 92, and you've been told the useful life of these assets is actually how many years? This item had an estimated useful life of 5 years. And of course, the lease was also in this case for how many years? 5 years. So in this case, you divide by 5. It will be able to give, in this case, the depreciation of this leased asset each and every year. It is coming to how much? It is coming to how much? 18,400. It is coming to 18,400. 18,400. Remember, we've already been told all depreciation should actually be able to go to what? To the cost of sales. We have to remember this one has to go to the cost of sales. So when you calculate the cost of sales, you'll have to do what? Add on this particular what? Amount. We'll have to add on this amount. We'll add on this amount. And then you have to remember under leases. You have to remember under leases. You have to remember under leases. We normally in this case determine the non-current liability element, the current liability element of the lease, and of course also what? The interest. There are these 3 key things you have to in this case determine. When you just hear a story about lease, you determine the non-current liability element of the lease, the current liability element of the lease, and of course what? The interest under the lease. The interest was having to be paid each and every year. And therefore also the other thing you have to determine is the right of use of the asset, which you've already calculated. But of course the examiner had given you. So I was just having to try to show you how this figure was arrived at. But if you have not given, you have to do what? Calculate. And this is how you calculate. You get the fair value of the lease liability. Then you add on any advance payment. Then you have to remember, is the lease actually in advance or